After 7 months of steady decline, Nigeria's external reserves returned to a growth trajectory, recording a gain of $679.12 million in the month of June this year. According to recent reports from the Central Bank of Nigeria, the reserves, which stood at $38.48 billion as of June 2nd, 2022, rose to $39.16 billion as of the end of June 30, 2022. Meanwhile, the tepid accretion to the reserves has been attributed to the apex bank's policies on constantly boosting forex supply to the country's economy through the non-oil sector. Now, joining me via Zoom to look at this development is a fiscal policy partner and Africa tax leader at PricewaterhouseCoopers, Mr. Taiwo Oyedele. Thank you so much for your time. Happy celebrations to you.
Thank you, Tolu. Happy celebrations to you and to Nigerians as well.
All right there. External reserves is gaining $679.12 million in just 1 month. First, I want to say that are we likely to continue to see this positive moving on before we go to the issues that are actually affecting the decline and the increase that we see in recent times?
Yes, that's an interesting perspective and question to ask. So I think, first and foremost, let's try and do an analysis of the makeup of the external reserve. So it has three broad components. There's the CBN component, which is essentially when we sell crude oil, the proceeds goes to the CBN, and CBN will keep the dollars and then give Naira to the Federation account for them to share. So that component becomes CBN reserve. Another component is federal government. So this is essentially when federal government will borrow, for example, issue Euro bonds. They could also have bilateral and multilateral facilities. So those instances, and sometimes including recoveries from loot, will constitute the component belonging to the federal government. The third component is the federation component. Now, this is the amount of reserve belonging to all levels of government that haven't been monetized or Naira-nized, if I may put it that way. And that would include things like petroleum profit tax, royalty from oil production, and also in some cases, taxes from companies under the Companies Income Tax Act, such as the Nigeria LNG. So having said that, I think the accretion we saw in June, I'm not convinced that this is now due to some interventions by the CBN that is now stimulating generation of foreign currency by the private sector. I don't think that is the case. I would imagine this is to do with taxes majorly, both PPT as well as companies income tax from NLNG, because if you remember, June is the deadline for paying taxes for many companies, including the likes of Nigeria LNG. I do think that these are the areas where the accretion is coming from. Of course, it's good news, but whether that is sustainable, I have my doubt.
I'm also thinking if the CBN will continue to have enough liquidity to fund the FX market, that looks like something that might just be in the short term. How do we sustain this moving on? Because we need this FX despite all the contending issues that we face.
Yes, that's a very important consideration for us as a people and for the managers of the economy. The challenges to do with COVID-19, to do with, Ukraine war and Russia and everything are not peculiar to us. They're also affecting other countries, whereas many countries are doing much better. A few countries are doing worse, like Sri Lanka. And you can, when countries are then struggling more than their, contemporaries, you can always pin it down to policy, either the inaction by government or making wrong decisions, both in terms of fiscal policy and monetary policies and trade policy. So for us to get to a point where we can earn foreign exchange sufficient to meet our demand, it has to be that there's a structural reform. Now, Imagine that your friend is organizing a party during this celebration, and they say for you, Tolu, it's going to be easy to be able to attend this party. You'll be one of the best. You're going to have a lot of fun, but we cannot give you assurances that you'll be able to leave, right? So chances are that you will not want to attend that party. So if we are saying it's easy for money to flow into Nigeria, but we create so much uncertainty for them to exit if they have to, then they wouldn't come. And that's not surprising why, foreign portfolio investments and foreign direct investments are pretty much drying up. And even diaspora remittances is not coming as it used to come. And even the private sector, many of them that do some exports, they procure the inputs when they have to buy this from abroad and equipment, essentially from black market rates. So they have to buy at 600 naira plus for their inputs. And when they do export, they will say, bring your proceeds and give it to the central bank at the official rate, which is around 420. Now, that doesn't make any economic sense. And therefore, it's difficult to encourage the private sector to do such a thing, given the very huge arbitrage and margin between the official rate in the I and E window, as well as, if you compare with the parallel market. So we need these structural reforms to help us to be able to sustain the generation of foreign exchange from all sources, private sector, FDI, FPI, and also to address the issue in the oil and gas sector, so that instead of us bleeding when the price of crude oil is going up, as an oil producing country, we should be celebrating and dancing to the band.
I'm also worried. Low crude oil production at this time, thanks to all theft and all that we face. And of course, the elevated price of subsidy, which we're paying under this same regime and all of that. That's the kind of regime we run with our downstream and all of that. But I want to ask you, really, what is the impact of all of these initiatives instituted by the central bank? There was the Naira for dollar thing. There we are looking at the RT200 FX. Well, a lot of policies are being introduced. Do you think that any of them is really giving us that impact that it should? Talking about the impact on the forex market.
Yeah, my answer would be no. Just to put it bluntly, so you have policies for diaspora remittances. But if you're going to give me maybe 5 naira for every $1, but I know that if I go to the parallel market, my margin is more than 200 naira. No rational person would embrace that opportunity. RC 200, although in fact, the more of these interventions you introduce, the more the indication that all is not well. You have to make the economy work for everyone, not targeting, a few segments of the economy, because the reality is whether you make effects from exporting services, exporting goods, exporting crude oil or gas, it really doesn't matter. You just want to earn effect, right? So therefore, you need to make sure that the policy environment is conducive for everyone to do their legitimate services and their legitimate businesses, whether you're small, whether you're big, whether you're multinational, whether you're into services, entertainment, creatives, oil and gas, it shouldn't matter. When you have those interventions because of unforeseen circumstances, an emergency situation, it's okay, but it can become the norm, right? When you make the exception becomes the norm, then that in itself is an invitation to crisis. The central bank, I should say, the Monetary Policy Committee, recently increased the MPR by 150 basis points. What should happen under ideal situation is for you to then attract a bit more effect, right? Because the interest rate is higher and people are looking for margins and returns on their investments. Then it should come in your direction, but we haven't seen that. Essentially because one, the uncertainty around the effect, monetary policy, of the government, and on the other hand, it's also the uncertainty that is partly, due to the fact that we have a pre-election year and we have issues to do with insecurity and all of that. So nobody feels very safe with their investment. to send them in our direction at this time. So we continue to struggle to find the FX to meet our demand. Even though the size of the foreign reserve is robust enough, covers more than 3 months of import. In fact, should be able to cover, our obligation as a country over the next 1 year or thereabout. But the fact that, even today, you go to the, foreign exchange market, even the marketers importing diesel are saying that about 70% of their FX needs, is met from the parallel market, not from the official market. And which is why the price of, diesel today is very high, because you can't get the official rate to import the refined product. So all of these then have implications for the economy and for the people fueling inflation, increasing poverty and the mystery index. And we just have to take a step back and say, this thing doesn't have to be rocket science. We have to find a way, given the circumstances we find ourselves, to design the fiscal policy and the monetary policy to be able to help us, make progress. In the area of fiscal policy, everybody has been talking about this subsidy, and it seems to be getting out of hand. We can't even account for how much exactly we consume daily from, petrol, and therefore this thing can easily cross 6 trillion at the end of the year, which should be more than government revenue. These indicators are not very different from, the issues that led to the crisis in Sri Lanka. God forbid we won't get to that point, but we have to do more than praying. We have to take very practical steps.
Indeed. Now, there are some policies that have been advised, or that many say, if followed to the latter, might help us get a bit maybe out of it. That's further adjustment, maybe devaluation, one way or the other. Let's just put it straight. That is what it is. And of course, flexibility in the exchange rate. Some say this might help attract investments and maybe add some value to the naira. What do you think?
Yeah, I think if you just devalue without, having complementary policy interventions and initiatives, it won't give you the results you're looking for, right? You just complicate the problem. You move the official rate to 600, and the parallel market rate will go to 800, right? Because the fundamental issues are still that we're pushing too much demand into the parallel market away from the official market. First, you have a list of about 43 items that are, even though they are not contraband, they are not prohibited for import. And then even for things that are eligible for FX, vast majority of people can't find the foreign, currency in the official market, from manufacturers to importers of diesel. Sometimes up to 90% is sourced from the parallel market. You have to find a way to move the demand from this parallel market to the official market, and then you can drive flexibility in the exchange rate and limit the rationing you have. Because the reason why you're having to ration is because the market is not supplying enough dollars. But if you address the issues with the foreign currency policy and the market is supplying its own dollars, then you won't have to ration it. And then the market can deal with the, the rate as to what it should be. Let it be that the parallel market is only for, contraband, black market, legitimate transactions like politicians buying dollars to go and procure delegates, and drug traffickers buying FS from the market. Let them go to the black market. Let everybody doing legitimate business go to the official market. Let the market forces determine the rate. Complement that with other policy interventions, both fiscal and otherwise, so that there can be inflow of foreign currency into the market. In my view, these are the ways I think we can address this problem, which is, not longer now. It's no longer now a short-term problem. It's becoming almost a permanent problem. So you cannot deal with it by introducing short-term, solutions.
Well, this is a good way to wrap up this conversation. I've been speaking to Mr. Taiwo Oyedele there, who's a fiscal policy partner and Africa tax leader at PricewaterhouseCoopers. Thank you so much. I do enjoy your holiday.
Thank you for having me.